AT&T. If you look at their numbers, their dividend, their PE, you may think that this stock is selling for an absolute bargain, but the further that you dig into the stock, the more you realize that this is actually not really the case. So AT&T is what I call a dinosaur company. It was founded in 1885 by Graham Bell, who originally patented the telephone itself. AT&T stands for American Telephone and Telegraph Company. Telegraph. It just shows you how the company is. And after changing and molding the company throughout the years, they are still a telephone company, except of course they mainly do cell phones now, and they're also very big in the offering of the internet, fiber, and mobile internet as well. The way they diversify their revenue is into three key segments: communications, Warner Media, and Latin America. And we can now take out that Warner Media section of revenue because AT&T have sold their Warner Media holding. So basically, let me just take you back. AT&T, they bought Warner for $85.4 billion in 2016. And then just 6 years later, they sold it for $43 billion to a merger with Discovery. Absolute first-class investing from the CEO here. Not a waste of shareholders' money one bit. All I can say is I feel sorry for anyone who owned AT&T over the past 6 years with that terrible waste of shareholder money. At the time, the then CEO Randall Stephenson called the pair a perfect match and had complementary strengths between the two businesses of Warner Media and AT&T. It just shows you not to buy everything that the CEO says because they so often turn out badly, and it was, in this case, the shareholders who lost this investment, not so much the previous CEO. The CEO manages the company, the shareholders are the one who own it and have their money in it. So let that be a lesson when it comes to a company making investments and acquisitions. A lot of the time, they're making an investment to appear busy and active, but the underlying investments can work out very bad. And that was bad investment number one for AT&T. They lost $40 billion in 6 years, but that wasn't their only bad investment. Let's look at DirecTV. So AT&T acquired DirecTV in a transaction valued at $67.1 billion. They did this to increase their market share in the pay TV sector, or so they say, apparently. And then in 2021, they sold off 30% of their DirecTV business for $7.1 billion in cash. So that values the entire business, 30%, the entire business at $24 billion, which means somehow they've already devalued their DirecTV investment by $43 billion. AT&T are just the king of making bad investments, and I have no idea what the old CEO could ever do to make up for these terrible investments, losing shareholders almost $100 billion. I would be so angry if I was a shareholder, but full disclosure, I am not an AT&T investor, so I didn't lose any money. Now let me show you what they should have done with their money if they were more ethical and more competent. Let's look at AT&T's balance sheet, something which too few investors go into. They don't dig deep into the actual financials. If we go to the most recent quarter and we look at their total debt, they're sitting on $150 billion of debt that they owe. Now this may be manageable at this point in time with the current relatively low historical interest rates, but what is Jerome Powell, what has he been doing with interest rates? He has been rising them, and he plans to continue to raise them. What will this do to AT&T's debt interest payments? The interest that they have to pay on that massive debt pile. It will increase them. With $150 billion of debt, this will affect AT&T significantly. If they were smarter, half a decade ago, they would have paid off a big chunk of this debt instead of making two really bad investments in Time Warner, which was now Warner Media, and DirecTV. But no, they wanted to appear busy and active and growing, so they wasted shareholders' money on these two very silly investments. But this is what happens, I guess, when you get a company that's well over 100 years old and the CEO who runs it never built it in the first place. A lot of the time they've never fully run or started a business and they don't know the true entrepreneurship journey. They just have a bunch of money that's being given to them. They're now CEO, they now have to manage it, and they make these stupid acquisitions. Honestly, if I was an AT&T shareholder, I would have been so angry at these bad acquisitions by the then CEO. Okay, so the debt and the investing history of AT&T is very bad. But I'm not gonna lie, AT&T do have some nice numbers elsewhere. First of all, low PE business. It's sitting at 7.5, which is very low, and the dividend is 6%. That's very high. Exactly what you want, low PE, high, and also some people like a high dividend. It can be good depending who you are, but I still think they should be using that dividend to pay off their massive debt pile. But hey, call me crazy for wanting to pay off debt. The other thing that is quite nice is their price to book. It's only 1.07 right now. This means that the price is only 7% more than the total net assets of the business. So if you think about it, worst comes to worst, the whole business fails, let's say the whole business fails, you can liquidate the business and you lose about 7% of your money. So although they have a terrible amount of debt and a terrible acquisition history, they do have a few nice numbers going for them. Low PE, low PB, and a high dividend. Anyway, I think it's high time that we got into the intrinsic value calculation of AT&T. Okay, so these are the figures that I've used for AT&T. Their cash flow for the entire business is $25 billion. I'm just gonna do things in thousands of dollars to make things fit better. The PE ratio in 5 years' time, I'm gonna use 7. Right now, the PE is just above 7, so we'll say it drops below to 7. The growth, now for that, I'm gonna look at analyst estimates. Analysts estimate, well, they actually estimate earnings to decrease over the next 5 years by minus 4.46%. So let's put that into the calculator that they drop by 5% every year over the next 5 years. Okay, let's move on to discount rates. For AT&T, I'm gonna want a higher discount rate. It really isn't the greatest of all businesses. If you compare it to Google and other amazing businesses, AT&T is pretty bad, just in terms of effectiveness of the actual business itself. So we'll do a 12% discount rate. Okay, and that gives me an intrinsic value of $20 per share. And I just want to say that I am going to be putting all of these intrinsic value calculations to the people who join the Investing Academy for the premium group. The link to that is in the description, and you also get to see the actual stocks. Out of all of the stocks that I study, the ones that I choose to buy. But with this intrinsic value calculation on AT&T, I do think we are missing one important piece to the puzzle, and that is AT&T have a lot of debt on their books, and I want to include this debt in my intrinsic value calculation. So remember, I said earlier that they were sitting on $150 billion of debt. Well, if we buy the whole business, like Warren Buffett teaches us to when making calculations, he said, make your calculations as if you're buying the whole business itself. So let's take into account their entire debt pile. So yes, we've got all of these cash flows here, but then we owe $150 billion. So what I'm gonna do is take $150 billion out of this figure here, and then I'll add the $60 billion which they have in current assets. Okay, this gives us a present value per share intrinsic value of $8.50. This is well below their current price of $18.30. So for me, the price of AT&T is selling above the intrinsic value of the stock. It's too expensive for me right now, and this is why I do not want to own the stock. The reason being, the reason that ruins it all is that massive debt pile. It just ruins the intrinsic value of the company. They should have paid it off a long time ago when they had all of that cash on them. For me, the old CEO of AT&T has almost ruined this company by overspending on investments that did not work out well, and it was the shareholders whose money he lost on this one. You won't see me buying AT&T unless it goes dramatically lower in price. And I do a lot of research before I make these videos, by the way. And for me, I think Sven Carlin, he described the stock the best. He called it a limping horse, referring to Warren Buffett talking about stocks and limping horses. And that limp for AT&T is its debt. It is really going to hurt them probably at some points in the future. As an investor, what you want to do when the stock is selling for a reasonable price and when that horse is not limping, you want to sell that horse. That is my opinion. That's how I view things. This is not financial advice. Make your own opinion on the stock. Just try look at the facts that I say in the business. Don't worry too much about my opinions. That's what I think. That's what I try to do with everything. I just try to look at the facts. Okay, if you're talking about an opinion, that's just opinions. All I care about is facts. And the fact is, AT&T have a ton of debt, too much debt for my liking. And the business isn't the greatest of businesses. It's very old. It's not in the greatest of industries. They constantly have to innovate and make 5G. So they're disrupting things. But what business are they disrupting? They're disrupting themselves. I won't be buying AT&T unless it absolutely shoots down like a rocket.